Welcome back to Accounts Decoder. Today we are tackling a topic that can make even the most seasoned accountants cringe: goodwill impairment. It sounds a bit technical, but don't worry, I will break it down. So, what is goodwill impairment and why does it matter? Let's dive in. Goodwill represents the value of a company reputation, brands, customer base, and another intangible asset when it acquires another business. It's an asset that is recorded on the balance sheet after an acquisition. However, sometimes things change and the value of that goodwill isn't as high as it once was. When this happens, you have to recognize a goodwill impairment, meaning the value of the goodwill has decreased and it's no longer worth what was initially recorded. This can happen for a variety of reasons, such as a change in the market, the business losing customer, or an overall decline in the company's financial health. When goodwill impairment, you must reduce its value on the balance sheet to reflect the new lower value. Let's look at how this works in practice. Suppose you initially recorded goodwill was 5 lakhs when you acquire a company. However, after some time you realize that the brand's value has dropped significantly and the goodwill is now only worth 3 lakh. The difference 2 lakh represents the impairment loss. To record this impairment, you make the following general entry. Debit impairment loss 2 lakh. Credit goodwill 2 lakh. This entry shows that the goodwill value on the balance sheet has been reduced and you recognize the loss as an expense on your income statement. This impacts your financial because the impairment loss reduces your net income for the period and the goodwill on the balance sheet drops by the same amount. Now let's talk about the impact on the balance sheet. Before the impairment, your balance sheet shows goodwill 5 lakh. After the impairment, the goodwill will be reduced to 3 lakh. This means your total assets are now lower, which can affect various